Hello, everybody. It's Gerry Scott here from the Snowbird US Day Tracker podcast, or sorry, let's call it the Snowbirds Expat Radio podcast. Today we have a third-time returning guest. We got Robert Clegg from CanadAmerican Tax. Now, he is in Victoria, but the rest of the gang is spread all over BC. Is that correct, Robert?
That's correct. We have Alex over in the Vancouver area, Surrey, South Surrey, right next to the border. Gerry, he's over in Calgary, and Stas is over in Calgary. So there's four of us, and we're in several different locales.
So we're going to start saying you guys really are becoming a global firm if the world only consisted of Alberta and BC here. So
absolutely.
Congrats. Yeah. Well, before we get into these questions, and this is really going to be geared, there's a lot of things going on right now. I'm going to go down this road for a little bit here, but before we came on air, Robert and I were talking about Robert's going to be in Maui on October the 15th, and I'm going to be there as well. So we're going to make sure that we hang out with all Jeff Bezos out towards McKenna there, being sarcastic here. But I said I would make sure we had a beach just ready for Robert and his gorillas that he'll be traveling with. And but tell me, and the reason why I'm bringing this up is because we know that Maui has really slowed down with the mayor talking about his Mariota list of all these 7,000 short-term units that are going to be possibly taken off the market through short-term rentals because of the housing crisis, which was created or magnified because of the Maui fires on August the 8th, 2023. So today's podcast is really going to be talking about when a Canadian goes to sell his place in Maui or Palm Springs or Scottsdale, whatever the case is. But Robert, before we get into these questions, tell the viewers a little bit more about your firm and what you guys specialize in.
Well, we specialize in all things tax, Canada, United States, cross-border, right? So give you a couple of examples. I do all the personal for U.S. citizens that are resident here in Canada. We have a lot of U.S. citizen clients in the United States, California, Arizona, New York, all over. And then Canadians, lots of Canadians that either invested into various real estate partnerships or hold rental properties personally and are required to file a U.S. and state personal income tax return. That's really the bread and butter of what I do. We also service Canadian corporations that do business in the United States, partnerships, entities, right? LLCs, seem to get a lot of those. Canadians that own LLCs operate through those. That's just to name a few. So anything U.S. we definitely can handle, and also we're very skilled on the whole cross-border regime as well.
Well, I think for a lot of folks, last night we had the debate between Harris and Trump. That was very, very interesting, and my wife and I actually watched the entire thing. I keep on telling my wife it's a good thing we don't have to vote. Because it's very confusing. I mean, a person could be attracted to the calmness of a Harris at the same time. If you are a Republican, if you are left, if you are very right-sided when it comes to your politics, I think you're trying to ignore what Donald Trump is saying and just try not to get too much of. He tends to kind of go off script a lot, which I think kind of hurts him. But on that note, yes, it was very entertaining last night. But let's get right into these questions. And Robert, I don't know if you got my email, but I've added a couple of questions to it as well about this topic today, which is as it is related to Hawaii, because we're getting a lot of calls from people that own homes in Hawaii, in Maui, that are concerned about these August 8th, 2023, this event that occurred, which is now causing politicians in Hawaii, right or wrong, but they're trying to look after the local Hawaiian people by maybe taking those 7,000 units off the Mariota list. So I think the timing is great for us to really go into this topic of, the selling of a Canadian who's going to sell the U.S. home. So my first question is, if I sell a piece of U.S. real estate, when and how, when do I get my ITIN number? Do I get it before the sale or do we get it after the sale?
Okay, well, there's if the client doesn't already have an ITIN, because maybe they needed the ITIN because of U.S. withholding requirements, sometimes the property manager will require it because they may have to make estimated tax or withholding tax payments to the IRS. But generally, what I see are Canadians, they have properties, and you have to distinguish whether the property is a rental or if it's just held for personal use only, right? So if the property is for personal use only, there is no requirement to have an ITIN until you actually sell it, right? Even if you sell it and you don't have an ITIN, they can still process the withholding and the withholding slips. They can make the remittance to both governments, Hawaii in this case we're talking about, and also the federal government, the IRS. Don't need an ITIN to complete the withholding paperwork that goes in advance, that goes subsequent to the sale of the property. Then when it comes tax filing time, and again, if it's a property based in Hawaii and the person is Canadian who sold it, due date is June 15th following year. So if you sold it today, you wouldn't have a filing obligation until the following year, June 15th federally. State of Hawaii is a little bit different. It's 1 week after the April 15th deadline. So, you just have to make certain that if you can't make the Hawaii deadline for both the federal and the state, to extend and make any estimated payment to Hawaii that may be due, right? So that's when they would file. At an extra wrinkle, they're not going to be able to, complete their Canadian filing until their U.S. filing is done, and that's because on the Canadian filing, assuming the property is sold at a gain, which probably it will be based on the skyrocketing values we've seen as of late, they need to claim foreign tax credits for any taxes paid the IRS and the Department of Revenue in Hawaii. And you can't do that until you actually complete the U.S. filings, file them, and then you request transcripts from each agency.
Now, how important is that? Is that ITIN number, excuse me, does that come into play when you're trying to do the Canadian tax return? Is there numbers that are being lined up?
It's only the ITIN is issued by the IRS, and it's unique only to the IRS. It's the same number composition as a social security number, but it's reserved for individuals that are, one, foreign, and two, are not eligible for a U.S. social security number. So, for example, if there's a Canadian who is working down in the U.S. on a TN visa, you wouldn't get them an ITIN. They would be eligible for a social security number, which likely they would already have because they are likely being paid through their company's payroll system, and you can't issue, you can't do payroll without a U.S. social security number, right?
And I guess the way I should have worded this is that, so in order to prove that you've actually paid this tax in the United States, so all they're doing is taking the entire tax return and using that information on the Canadian side as well.
Yeah, the CRA. A couple of months after you file the T1, Canadian Personal Income Tax Return, the CRA always sends a letter for foreign tax credit verification, right? And the letter requests copies of the federal and state return. So in this case, it'd be a 1040 NR and a Hawaii N15 non-resident return. Copy of the IRS transcript, withholding slips that we'll get into in a little bit, but they're called 8288As. And then proof that the Hawaii tax was paid. And that can be done a number of ways, right? I always ask my clients to be sure they have a U.S. bank set up so any refunds or amounts due can automatically be debited from those accounts and sent directly to both the IRS and the Department of Revenue, right? And that's one way that the CRA allows for substantiation, foreign tax credit substantiation, at least on a state level. You can give them a copy of your tax return, and it shows the amount that was refunded and deposited. That amount's going to match what was on the Hawaii tax return. And then they can extrapolate from there, saying, okay, it was filed, they got their return back, tax return shows this amount of tax that was ultimately paid. We're all good, and it's substantiated.
So what happens to, I'm just having a little thought here. So let's say, for example, you have your property, you've sold it before, you've had your ITIN number before, but now you've applied for you've been granted an E2 visa. Now you have a social security number. What happens to the ITIN number? And is that ITIN number just issued once in your life? It's still out there, or? The
ITIN is issued once, but it can expire. There is a process you can use if you now have a social security number. You can notify the IRS that the valid social security number was issued, and to transfer any information that was previously issued under the ITIN to the new social security number.
Now, every state is different depending on how much money they hold back.
That's correct. A state like Arizona doesn't even hold back.
Okay.
Yep.
So in this case, in Hawaii, we're going to make this all about Hawaii again. We're going to make it all about you, Robert. I don't know if you're good with it or whatever.
It's my favorite state.
Okay. Yeah. So is that 15% that they would hold back in Hawaii?
No, it's much lower. It's right around 3.5%. Excuse me, 3.5%.
Okay, so there's two parts to the question. Why do they hold back that money? And the question is that how would I get that money back?
Well, they hold it back in order to force the non-U.S. person to file income tax returns, right? Decades ago, before they had the FERPA withholding, it was common. Foreign nationals would sell their property, they'd take the cash, and they'd leave. And there's really no mechanism for the IRS to enforce that, or to force the taxpayer to actually file a tax return, pay the tax, and then have a refund coming back. Well, in this case, if there was no withholding credit, there would be no refund. They would just owe. So what the IRS decided is, hey, let's make withholding mandatory for sellers that are not U.S. persons, right? And so that's what they did. They now require 15% withhold on the gross proceeds. That goes in advance to the IRS, at which point, when you do file your tax return, there's going to be a credit equal to what the amount was that was withheld on the 1040, and the difference will be refunded as a tax refund, right? And the reason it's typically a tax refund, it's almost always a tax refund, is FERPA withholding is based on the gross proceed, right? Whereas your tax is based on net. So that's the big difference, right? So obviously, if the 15% on the gross amount of sale, it's going to be much greater than what ultimately the taxpayer will have payable as a result of a capital gain.
Now, is there a certificate? Because I've heard clients have just kind of let the time go by, and they did not file in time. They've had that 15% being withheld, but then they got themselves in a bit of trouble. Is there a certificate that needs to be issued to make sure that there is no more tax obligation?
Well, that's in the case of like an estate. There would be, and you have to file a different form, U.S. estate tax return for non-residents. Takes about 1.5 years to process. Then you can also request a clearance certificate, and basically that certificate is issued by the IRS, and it states that the estate owes no federal tax as it applies to the sale of that of the condo that was part of the estate, right? Then you provide it to the transfer agent, and they can then change the title from the name of the decedent to the beneficiary, and then you can execute a sale.
Okay, and I think you kind of mentioned this, but how am I taxed on the sale of the U.S. property? I think you kind of mentioned that it is on the net proceeds.
On the net, yep. So you take your proceeds, exactly the same as it's done in Canada, right? You'll take your proceeds, your cost base, and then you'll net that from your cost basis, how much you paid for the unit or the property, the house. Any substantial additions, maybe you had to get a new roof, you got new kitchen, bathrooms, you'll add that back in. You can subtract then your cost of sale, right? Commissions, legal fees, etc. And then what you're left with is going to be your net gain, and that gain is subject to capital gain tax. That's posted by the IRS. Same thing's true for Hawaii as well. They're going to take the gain and subject it to their own rate of tax, which is fairly low. It can go higher, but it's relatively low, 3.5%, 4%.
So if we start crunching the numbers in, so you say there's going to be a 15% withholding, and you say sometimes that can take up to a year and a half to get those funds back?
Well, it really depends. If you sell the property January 1st, you basically have to wait until the following April to file. And then it's going to take at least a few months to get that refund.
Okay.
If you sell it December 31st, it's only going to take a few months, right?
Now, is there a trend out there where people are actually, they're better off to sell the properties in the later part of the year?
I think the trend is they just want to offload these properties because they may be feeling distressed, and it's better to sell it and have and just offload. Financially, they're in a better position, and then they'll file when they can, and then the refunds will come. There is a mechanism whereby taxpayers can request a reduction in withholding. But again, those take a year, right? And it's really, you really need consent of the escrow company and the buyer as well, because under the rules, it's the buyer's obligation to ensure that FIRPTA is complied with. So, if you've got a buyer from California and someone says, hey, would you mind if you signed off on this Form 8288B? Because the seller, who's Canadian, would kind of like to have this cash available. Chances are they're going to say, forget it.
Yeah. Because you really could be out of pocket when you think about it. You got your 15% withheld. You got your capital gains tax that you're going to have to pay on the U.S. side. The foreign tax credit will allow you to offset some of the tax, but then you're going to have to pay capital gains in Canada as well.
Absolutely, and you have the exchange ratio, the exchange differential. So, your basis could be a lot smaller, or it could be a lot larger. It just depends on when you bought it, right? When you made these improvements, because all of those US dollar figures have to now be converted into Canadian dollars using the appropriate spot rate between the two currencies, right? And so, yeah, you could be subject to an even higher gain in Canada. And now with the increase in the capital gain rate, you're going to be paying more anyways.
So I'm gonna jump to question number 7, because now I'm going to be talking about, I think, what's going to happen with a few of these people that have bought homes in Maui the last couple of years, and now we're dealing with this event and what the mayor is trying to accomplish over in Maui. What happens if a person has a capital loss? Are they able to carry that capital loss on that property to a capital gain on the Canadian side?
Well, if the property, and most of those properties are rentals, and we'll just talk about rentals. So for US purposes, if it's a rental property and at the end of the day there's a capital loss, you can carry that forward, right? So you'll have that capital loss waiting to be used in future years, right? And I believe you can carry it up 20 years. Same thing goes for Canada, right? So because again, if you sell the property, we're assuming that each year it was rented, it's been reported on US federal and state returns. And it's also been reported on the T1, right? Along with foreign tax credits, etc. So when it comes time to sell, if there's a loss, those losses for US purposes are suspended until such time you need them, right? Maybe you'll go buy a new condo, or maybe you'll invest in a piece of real estate through, say, a U.S. partnership, right? I see that quite often. In future years, when that sells, then yeah, you can use the carry forwards to offset that gain, which ultimately would reduce your U.S. tax liability. almost the same rules apply in Canada if it's a personal use property, right? Vacation, never rented. You have to recognize the gain, but you can't recognize the losses, right? They consider those just personal in nature. But if it's a rental, which I'm almost certain almost all of them are, why would you just have a piece of prime real estate like a condo or a house just sitting idle, right? Typically, that just never happens. Same thing applies in Canada. If you have a loss, you can either utilize it in the current year or you can carry that forward and offset future gains with those losses. But again, it's really a Canadian issue. I'd vet that with your Canadian tax account because there may be some nuances that I'm missing. But as a broad overview, it is possible in Canada to utilize those losses in future years.
Okay, so boy, there's so much to know about this, and like I say, this is really becoming. We're heading to Maui on Monday, which will be September the 16th, and we've got so many people that are calling us through the app, asking us about the situation. Rentals are these people are getting worried. Properties aren't moving, so we're going to spend some time with.
Well, it's my understanding that the new rules would kick in May 2025.
And I'm still not 100% sure. There's one of the guests on our show was a guy named Paul Aker, and he was an investigative reporter, has a service over in Maui called Maui Alert. So he's been really on top of a lot of these things going on. I've got friends over there that are lawyers, fifth generation Hawaiians, and they're really following this very, very closely to see what's going to happen. I know there was about $300,000 that was allocated for the food bank in the Maui budget. It's now being used on the study to see, what impact could it have on those homes in Maui. And there's a great article done by economist he was with the University of Hawaii, and then he's now with the Bank of Hawaii. And I want to say his name is Paul Brewmaker, or first name Paul, Brewmaster, Brewbaker. And he was mentioning, he did a study in November 2022, and the impact would be about $1.4 billion in the economy, 14,000 lost jobs, and about $230 million in revenue. So we sure hope that this $300,000 will come up with the same information where they're going to be able to act on what's in the best interest of everybody that's part of Maui. Mm-hmm. So it's a difficult thing, and I was always told that if you might sit on one side of the argument, but to really understand the other side of the argument, spend about 2 weeks understanding and taking the other side of the argument so you can really understand what's going on. Okay, so now we're talking about, I jointly own U.S. property with my spouse. Do we file a joint U.S. return?
The answer is, again, if they're Canadian citizens, not U.S. persons, they cannot file joint. They have to file individually. And so they'll each file their respective 1040 NRs, Hawaii returns, and then calculate the tax, apply the withholding credits, and then again, file individually in Canada and then claim the credit. So it aligns really, really well with Canadian tax filers. The other thing is, I find often, and I've spoken to a lot of escrow companies, sometimes they're under the assumption that they can indeed file joint returns. And so they'll prepare those withholding slips, the 8288A slips, jointly, right? They'll report one person's ITIN, both names. That becomes problematic because when you prepare the return, you have to put the full credit on only one of the returns, the one that has the taxpayer's tax ID number on it. The other tax return doesn't have withholding credit. And so you can get into a situation where, one, there's a large payable, and two, there's a potential for penalty, right? So what we do is when we see that, we'll contact the escrow company and we'll ask that they amend the slip and, well, the filing, it's called an 8288, and they'll amend the slips, the 8288As, by splitting the amounts and reporting 50-50 on each set. And then they'll submit that back to the IRS. And it usually does the trick, right? Come tax time.
Now, just a reminder as well is that Robert is a dual citizen of America and Canada. So I have to point that out because I know there's a lot of Canadian accountants that are performing cross-border tax, but they're Canadians. They're just strictly Canadians. They've learned the craft of being cross-border. So with Robert, you did spend a lot of your time in the United States, obviously.
Well, I spent my first 40 years in the U.S. Yeah, and that's really where I got my start. So
okay, so Robert
worked for Big Fours and then came up here.
Okay. Now, I have before I ask this question, is that how often do you come across a Canadian? And we know this is wrong, this is offside, but sometimes these Canadians are doing crazy things. Canadian, so I'm speaking for all of us when I say crazy. But have you seen Canadians trying to utilize the 1031 strategy and getting themselves in a lot of trouble?
I have, and it simply does not work from a CRA perspective. So, I mean, we've gotten inquiries. We've said, look, don't even try it. It's not going to work. For U.S. purposes, it probably would, but it's going to fail on the Canadian side, right? And then I never hear back from them. So,
okay. So let's talk about the 1031 for a second and just explain to the viewers what the 1031 is for a U.S. person, and then why it does not work for a Canadian person.
Well, it's just basically an exchange. You can go from a low basis property with lots of built-in gain, and you can exchange it for a property of greater value without having to pay tax on it. So you're basically deferring the tax when you do this 1031 exchange. It's a whole cottage industry in the United States. There's firms that all they do are 1031 exchanges. But for Canadian tax purposes, my understanding, they consider it a realized gain, a disposition. So you have to report it as a sale, right? It's not tax-free. You would report that as a sale and with a subsequent purchase of the new property, right? So it fails in that respect. It would be considered a disposition for Canadian tax purposes, and you'd be paying tax on it anyhow. And then your credits, you have no credit, from a U.S. perspective to apply on the Canadian tax return. So, and then when you do ultimately sell that exchange property, you're not going to be able to take the credit on the Canadian. So it simply does not align between your U.S. and the Canadian filings. So it's advisable not to try.
Okay. So here's a question as well. Is there any way that you can be exempt from federal tax withholding?
It is, yeah. FERPTA, there's the $300,000. If the fair market value of the property is $300,000 or less, and the buyer intends to use it for personal purposes at least 50% of the time for the immediate 12 months subsequent to sale, then FERPTA withholding can be waived. Again, you have to run that by whoever's doing the transaction, the escrow company, the law firm. My experience, they're cautious, they're conservative, and they're going to withhold regardless, right?
Yeah.
Okay. But it can be asked. It can be asked, right? But if the buyer is intending just to put it into service as a rental, then no, it wouldn't. It would fail that second prong. Right.
Okay. Yeah. So here's one of the questions that I've asked, and this is coming up a lot with the Canadian capital gains for corporations. There's, it's now going to be 2/3, which is a big deal. I guess it's anytime you're raising tax, it's a big deal. As an individual in Canada, you're paying $250,000. You get the exemption at 50/50, and then it goes up to 2/3 after that. After that amount. So my question is, because of that, we say that there's a lot of, we had a fellow named Kevin Nightingale on the last podcast, and he was talking about Canadians exiting Canada.
Mm-hmm.
So let's say, for example, for the last 20 years, I've owned this property in Wailuku. And now I'm planning on exiting Canada. that property comes into play.
It does. For Canadian purposes, the deemed disposition, exit tax. It certainly does. All property worldwide has to go into the mix. Of course, there are exempt properties, RSPs, pensions,
Personal real estate.
personal real estate, principal residence exclusion, but vacation properties, vacant land, stocks, bonds, that all comes into the mix. And, for Canadian tax purposes, because in Canada, we're taxed on a residential basis. When you sever that tax tie to Canada, Canada considers you as having sold all of your capital assets the day after you leave, right? And then you calculate the gain, and then you pay the tax. Same thing happens on death, right? They consider you as having resurrected and sold off your property.
A deemed disposition. So when we start looking at the numbers, when a person, let's say, for example, you paid $1 million for this home, it's now worth $2 million. So there's a capital gains of $1 million US on that property.
Mm-hmm.
And now I decide I'm going to exit Canada. So the amount of tax that I would owe on that $1 million property, it could be in the hundreds of thousands of dollars for me to exit.
It could be, you bet. Under the treaty, there's an option where you can trigger the gain for US tax purposes, and then you can claim a credit on the Canadian. But again, that would require a lot of liquidity on the part of the seller, right? Because you'd have to come up with the amount to pay both. Well, you wouldn't pay Hawaii, but you would pay the federal government, right? You would get the step up basis for US tax purposes, even though you didn't sell it. Same thing's true in Canada, you'll be taxed on the way out. So once it sells, I'm assuming the person would be a US resident, and then they would pay and calculate their gain, whether they take that election or not, right? But for Canadian tax purposes, you're taxed on the way out. I do know that there are principal residence designations that you could look at to see possibly if the Hawaii property could be claimed as a principal residence. But again, you likely have a principal residence here in Canada you're going to have to use it on, right? You can't use it on both. So long story short, CRA is going to get you on the way out.
Well, that was the big shocker for a lot of our viewers that they call in and ask us about that. Kevin Nightingale was with M&P for many years, and now he's working strictly for a law firm out of Montreal. So he really does know his stuff. He's been practicing cross-border tax as long as anybody, if not longer. And so many people were shocked that property would come into play in Canada. So I guess the story is that they're making it hard for us to stay, and they're making it even more difficult to leave.
Yep, I still think thousands are leaving, for sure. Going to places like the U.S. is a popular destination, Spain, Portugal, Greece. Those countries make it easy for Canadians to relocate. They offer lower taxes, easy visa access, good weather, and good food.
Yeah. And I think I'm not sure if I mentioned this before, but I read a book in the 90s, probably around 96, and it was called Take Your Money and Run. It was written by Alex Noyles. And we did have a dinner one night with one of our orthopedic surgeons, his client, close friend. He comes up to me after another long 12-hour shift. He meets me for dinner. And he says, the healthcare system's broken. Canada's broken. Get me out of here. And I got him a copy. I said, I'll get you a copy of this book. You'll love it. His wife is American. And it was very interesting because I went online the next day and I went into Alex Noyles, and Alex had his phone number, his 416, right there on the website. And Alex is now 84 years old. So I'm assuming he doesn't get as many calls as he once did. And when he does get a call, I had a 30-minute conversation with Alex. He's a very entertaining, funny guy who really knows his stuff. He was an analyst for one of the financial firms way back in the 80s. And he basically left Canada, went sailing around the world, became a resident of Dublin, I believe it was. And the stories that he was able to tell me, and then we had him on the podcast. It was so entertaining, I'll tell you. I wasn't sure if I was now going to be on the CRA target. Here I am. I'm giving time to this guy who's basically CRA tried to take to court, and they were unsuccessful. But I found Alex very, very, very entertaining, and something about an 84-year-old guy. They didn't have to be worried about how we said certain things back in the day. Everybody was offended, and Alex still hasn't. He's never had to have a filter.
Sure.
So I found it very amusing. But other than it sounds like we get to spend some time together on October 15th this year. If you're a golfer, we look forward to having you at CanadAmerican. If anything, we'll just drive around the carts, play some bad golf, and drink some of that Hawaiian.
Absolutely.
Anything else you want to add and people should be concerned about when it comes to when someone is about to sell their place? Do you try and have a consultation with them first?
I do, absolutely. I just ask that they give us a call, right? We'll go through, kind of get a feel for what sort of gains they're looking at. The big one is the FERPTA withholding, right? The 8288As. When you sell, escrow is going to give you a package, right? They're going to get a package called a HUD statement, housing, urban development, shows the debits and the credits for the buyer and the seller, basically reconciliation. They're going to also provide these sellers those withholding slips, both federal and the state. We just need to make sure those withholding slips are prepared accurately. If they're not, then we just go back to escrow and we ask that escrow amend the slips, resubmit to the IRS. Because if you don't do that, there's going to be a substantial delay in getting that refund. I just did one that the escrow company out of, I believe it was Arizona, completely botched. It finally took about 1 year and 3 months, an intervention by the IRS's taxpayer advocate service to get the withholding credited and the refunds posted to the taxpayers' accounts, right? That was an extreme case. I've got another one that, the escrow company, I basically helped them through the process on populating and just getting the amended slips prepared, signed off, and then back to the IRS. So, but I always like to be preventative on this. It just makes, because I know Canada's going to come asking, they're going to have to substantiate. And if they can't, then Canada's CRA is going to send them a big bill saying, hey, we couldn't substantiate your foreign tax credit, so pay up, right? And then they're on them. The CRA's on them like, a collection agency, right? So.
How about this? Well, this is going to be my last question before we let you get back to your beautiful day in Victoria. I know it's cloudy here, so I'm assuming it's got to be sunny in Victoria because I don't think you guys get any rain in Victoria, do you?
No. It's cloudy, it's rainy, and it's cold. So.
Okay. So if you have these parents and they're going to transfer that money, that ownership to the children in Hawaii, are they better to do it through estate planning and at their death? Or is it advantageous to do it before their death?
Well, see, if they're Canadians and they've got this piece of U.S. real property, last thing they'd want to do is to gift it, right? Because there's no credit available, right? There's an annual exclusion amount, which is like $17,000, but amounts in excess of the 17 will be fully subject to the U.S. gift tax regime, right? So the way you can transfer it, you're either going to transfer it as, maybe the kids buy it from them, or they're named beneficiaries, right? Again, if you have a Hawaii property, I was just telling my wife this because I'm looking at maybe buying some sort of a co-ownership with a few friends in Seattle, right? To have a will, a Hawaii will that basically details what and who the beneficiary is of the co-ownership, right? In my case, it'd be a co-ownership of this Hawaii property. If it's outright owned between spouses, then under local rules, it probably likely just transfer automatically to the surviving spouse, joint with right of survivorship. But then the county, right? Maui County, Honolulu County, whichever county, King County in Seattle, who knows? They're going to require that the property be transferred, and they'll need to see a copy of the estate tax return and a clearance certificate from the IRS before they do it. So even if the property automatically transfers to the surviving spouse, the decedent spouse, if the value of that condo is greater than $60,000, is going to have to file a non-resident U.S. estate tax return, which we could, next podcast, we could always get into that, right? Because I see it quite often.
So really, you're saying it's better for them to do it through estate planning? Through
estate planning, you bet. Yeah, you don't want to gift it. That's going to trigger a whole bunch of tax and a whole bunch of worry. So.
Okay, so Robert, once again, thank you very much for being on our show. It's very much appreciated. I look forward to seeing you on, excuse me. And as I take a sip of my my Pepsi Zero, I always got to show people that we've got the QR code that has all kinds of great blogs on it. I'm sure Robert has those. I
do. I have that mug in front of me.
Well, there we are. I thank you again. I look forward to seeing you on October 15th. And
absolutely.
I know we're flying the next day, so it's always nice to see people in person. And I'm sure I'm going to get a really eye-opening experience here over the next 30 days. We're in Maui to see where we're at, and we'll keep people updated. So, Robert, I thank you very much for being on the show again. And I'm sure we'll have lots of things to talk about. The estate planning, as mentioned a few minutes ago, we look forward to covering that off as well. So,
well, thanks very much. I appreciate you and appreciate you having me on your show. It's always a pleasure.
Yeah, you're very welcome. And once again, everybody, the world is small and be kind to all.